Good morning again, and welcome to our Residential Outlook Conference for 2021. Can everyone hear me okay? If you can hear me okay, give me a quick thumbs up. Thank you very much. We've got a great lineup of speakers and panelists today, and excited to get our program rolling. I'm going to ask you all to do a few items today. New platform for us. We've been experimenting with it. We've got kind of a hybrid platform this time. So hopefully it works out well for everyone. We're still kind of trying to figure out our presentation formats to bring you the best presentation quality that we can. If you scroll down or actually just look to your left on your screen, you'll see a little student that says support student success. If you have an interest in supporting our student success, please click on that button. And I want to thank everyone thus far that has donated. We've got quite a few donations for this program, so we greatly appreciate that. One thing that's important, if you want questions for the speakers, please use the chat box that's to the right of your screen. There is also one that is below your screen. Please do not use that chat box. Use the one to the right. As questions come in, we'll catalog them. And then at the end of the panel discussion, we will have a Q&A. If you're a student, make sure that you fill out the form that Jackie sent out so you can get your passport credit. At the end of the formal program, we do have a networking session. So please try and join us for that session. It's a really great format where you can have one-on-one interaction with many of the individuals that have been on the call. A great way to get to know individuals that you may not have met. And a good way to get caught up with some that you do know. So please join us for the networking afterwards. You can access that if you look at your screen on the left-hand side, there's a little button that says networking. At the end of the program, just hit that button and you'll be good to go. Before we start the program, I would like to thank our sponsors. Needless to say, this has been a bit of a difficult year for our sponsors in that all of our events pretty much have been virtual. So I really want to thank them. Their sponsorship supports obviously the Burnham-Moores Center, supports the resource base we have, all of which that support our students. So we could not do what we do without our great sponsors. I'm going to take just a minute to recognize each one of them. You see the logos up there. I'm going to recognize the people behind the logos as well, because they are great advocates of our program and have been supporting it for many years now. AIM Loan, Vince Kasperik, thank you again for being the presenting sponsor of this great program. Two of our great corporate sponsors, MG Properties, Mark Glieberman, Joe Infuso. Always appreciate your support. US Bank has been our presenting sponsor for, gosh, I don't know how many years for our annual event. Mike Paris, Eric Arnaz, thank you. EY, Emma Epps, always appreciate your support. Another longtime supporter of ours, Solberg, Mickey Maher, KPMG, Lionel DeChamps, always appreciate your support in the golf game every now and again. Pacifica Companies, Ashes Ronnie, and one of our alumni, Derek Jensen. Torrey Pines Bank, Devin Foster, Union Bank, and a longtime supporter, Ronna Sampson, a good friend of mine at Voight, Eric Northbrook, thank you for your support, and at Wells Fargo, Dan Arbach and his team. So all of you, thank you very much for the support. Couldn't do it without you. With that, we're going to get our program started. I'm going to ask Norm now to unmute and start our program. Norm, take it away. Thank you.
Thank you. Good morning, students, alumni, attendees near and far. We have a good panel here, and I'm pleased to moderate this program. Let me introduce our speakers. Frank Nothaft is the chief economist for CoreLogic. He had the same role for many years at Freddie Mac. He worked at the Federal Board of Governors, and I'm proud to say he's a Homer Hoyt Fellow, a think tank of real estate scholars. He's going to be kicking off our keynote, but let me introduce our other two speakers as well. Kimberly Byrum is currently Senior VP for Zonda, also known as Meyers Research, with 20 years of multifamily experience. She leads efforts to track drivers in the housing markets, including demographics and behavioral trends. And we also have Peter Dennehy. He's the Vice President of Newland, the largest private new community developer in the United States, where he heads up market research. Peter worked at Meyers Research, John Burns, and others, most notable. He's got a law degree from the USD School of Law. So thank you very much for attending. Our format today is going to be starting off our keynote with Dr. Frank Nothaft, following some comments, a few questions, some comments from Kimberly and then Peter. Then we're going to open it up to all attendees. I also want to note that we have an appendix of slides. There's much more that we can cover in this tight program. So we put together some additional resources, some design trends from Kimberly, some other additional charts and graphs from Peter, and also from myself. So that's available to all attendees later on if you have an interest. So at this point in time, I'm going to pass it over to our keynote, Frank Nothaft. Thank you very much, Frank.
And thank you so much, Norm. And I want to thank the Burnham-Moores Center for Real Estate for inviting me here to present and meet with you all today. And I sure hope that the next time I have the opportunity to come to the conference, it'll be in person. What an odd and unprecedented year we have had. I know I, for one, can't wait for 2020 and the pandemic to be in the history books. We're not there yet. But hopefully we'll be there soon in coming months. I'll talk a bit about the impacts that the pandemic have had on the marketplace over the last few months, as well as a view into 2021. If we turn to the next slide, that'll summarize some of the points I'll be covering today. As you know, we have a record low level of mortgage rates, and it's led to a phenomenal refinance boom in the marketplace this year. I expect the low mortgage rates to continue into 2021. And with that, we're going to continue to see very strong refinance volume, not quite as strong as in 2020, but still quite strong, as well as a very brisk home purchase market. Home sales, as you know, have been actually have rebounded very well and have been pretty strong over the last few months. And I do expect that to continue into 2021. I see some weakness in the multifamily sector, even though that's starting to come around as well. And finally, I'll have some closing remarks about what I see for mortgage credit risk in the marketplace. Well, let's jump into it. Let's go to the first slide. I talked through a lot of charts, so I've got a lot of charts for the rest of my talk here. As you all know, mortgage rates are at a record low. We got the latest update from the Freddie Mac Weekly Home Mortgage Survey, 2.7% average U.S. 30-year fixed rate mortgage. The average for a 15-year fixed rate, 2.25%. And for those borrowers who have a very good credit history and a lot of home equity, they can get rates lower than that. Over the last decade prior to 2020, the average rate for a 30-year fixed rate mortgage rate was 4.1%. We're at 2.7, a record low. And I do see that continuing into 2021. And actually, I think we're in for an extended period of very, very low mortgage rates in through 2022. So for the start of 2021, rates again, very low, maybe creeping up a little in the second half of the year. And our forecast for the 2021 year as a whole is an average of 2.9% for 30-year fixed rate mortgages. A phenomenal rate. it's going to contribute to a lot of refinance volume and home purchase. Let's go to the next slide where we can take a little closer look at what we're seeing in our data for and why we expect to see a strong refinance volume. We have in our loan servicing database about 3/4 of all of the home mortgages in the United States. There's roughly about 50 million home mortgages outstanding in the US, and 3/4 of those are in our database. So we can take a look at the distribution of the contract interest rate on mortgages in the United States. And that's what these curves reflect. It's the cumulative distribution of home mortgage debt outstanding by contract interest rate. The curve that's a little bit more to the left is by dollar volume. The one a little bit to the right is by number of loans. The bottom line is that the median interest rate for loans outstanding is about 3.75%. And there's roughly about 40% of mortgages outstanding that have a contract interest rate of 4% or higher. 40% have a contract interest rate of 4% or higher. And we are at 2.7% for 30-year fixed rate. We're at 2.25% for 15-year fixed rate. There's still a large amount of home mortgage debt outstanding that's in the money to refinance. That's why I remain pretty optimistic that we're going to see a fairly strong refinance volume in 2021. I'm not projecting 20 million mortgages are coming in to refinance. That's not next year. No, we had about 8 or 9 million come into refinance here in 2020. A little bit smaller volume next year, partly because those loans that are still outstanding tend to have, with a high coupon, tend to have a low balance, and low balance loans are less likely to come in and refi. Or they're borrowers that have credit blemishes in their history. They may even be in a forbearance program or delinquent on their mortgages. Very, very hard to refinance if you're in a forbearance program or have had a recent delinquency. So I'm not expecting all those loans to come in, but I do expect we're going to see pretty strong refinance volume. And I expect we're going to see a pickup in home sales. If we go to the next slide, I'd like to just recap a little bit about what's happened over the last several months with the home sales market. And this is from our CoreLogic MLS data on new listings and inventory for sale. We get this data in every single day. What we have done here is sum it up by week. And we looked at it by week for this year because the market was changing so rapidly on a week-to-week basis. As you know, on March 13th, the president announced issued an executive order announcing a national emergency related to the pandemic. That's what that vertical line is. That's above to the left of the chart. That's when the president announced a national emergency. And shortly thereafter, we saw the proliferation of shelter-in-place orders in jurisdictions around the country. We saw open houses canceled. We saw listings get pulled from MLSs. And prospective sellers decide to postpone listing their home. And indeed, new listings fell about 50% relative to what they had been the prior year. So on these curves, we're looking at the percent change same week, year over year, comparing 2020 with 2019. New listings fell 50% relative to the same week in 2019. But what's so remarkable is the rebound that we've seen in the sales market. Partly, we've got to thank Chair Powell and his colleagues at the Federal Reserve Board for introducing an extremely accommodative monetary policy. As you know, they cut short-term interest rates, the Fed funds target, basically to zero, and they re-implemented a brand of quantitative easing by buying long-term Treasury notes and bonds and mortgage-backed securities. That's been a powerful driver helping to push down mortgage rates to the record low that we have right now. And we saw the response, not just with new listings, but with sales. If we go to the next slide, we can see what happened with both pending sales and settlements, closings. I like to look at both of those metrics. And again, we're looking at them on a week-by-week basis, new pending sales, new ratified contracts to buy homes on a week-by-week basis compared to the prior year. And after the pandemic, after the national emergency was declared by the president, gosh, we saw the pending sales just completely dry up. They were down, again, about 50% on a weekly basis compared to the same week a year ago. But they bounced back really smartly. I like looking at pending sales because it really gives us insight. It gives us a window into what will be happening with closings, with settlements, because there's roughly about 30 to 45 days separation between the signing of the contract, the pending sale, and when the settlement occurs. And if you look at the latest data, which is through the end of November, you can see pending sales are still up about 30% relative to the same week in 2019. And to me, that says that the strong level of settlements that we keep seeing in the data that's reported, that's continuing through December. I think it's going to continue into the beginning of 2021 as well. So strong, robust home sales activity. Now you may ask, well, gosh, this is great. Who's buying the homes? Well, it's millennials on the on this slide. It's millennials and it's Gen Xers. It's the first-time home buyers and it's the trade-up buyers. They've been the ones who've been driving the pickup in home sales. Millennials are the blue curve at the top, again, measuring weekly activity on a year-over-year basis, comparing it with 2019. The red curve right below them, those are the Gen Xers. The two of them are those two cohorts are really helping to drive rebound in home sales and keeping home sales levels so much above what they were even just a year ago. And clearly it's partly the record low mortgage rates that's providing that fuel to bring first-time home buyers into the market and Gen Xers to trade up to a larger home. A larger home that perhaps has the additional room for an office or work from home, or for a schoolroom or class at home. And that's what many trade-up home buyers are looking for. And let's turn to the next slide. And the next slide really looks at these two different dimensions of affordability. What I've been emphasizing the record low level of mortgage rates and how that's reduced the monthly principal and interest payments and really provided a big impetus for first-time home buyers and trade-up buyers. And we can do a thought experiment to see how the drop in rates has really helped reduce that monthly principal and interest payment. And the thought experiment is the following. Consider buying a home 1 year ago, and then let's assume that same identical home is on the market again here 1 year later. And the only thing that's really changed is mortgage rates, which are down, and home prices, which are up. And so let's do that comparison and see what that means in terms of the monthly principal and interest payment. And if you work through the calculations here, I made the exercise really simple. Just assume the 10% down payment, et cetera. The drop in mortgage rates of about a percentage point relative to what they were last year, even though home prices are up, translates still into a lower monthly principal and interest payment. And that is the sense in which affordability has improved and provided an opportunity for many young families, many millennials, to transition into home ownership for the first time, and for Gen Xers to take that opportunity, those who have been homeowners, to trade up to a larger home. Now, there's a second dimension to affordability, and that's the nest egg that you need to have in the bank so that you can pay the larger down payment, closing costs, and still have the necessary liquidity that underwriters are looking for after you settle on the loan. That's gotten to be a little bit more challenging because prices are up. So for many first-time home buyers especially, that's some of the tension about affordability. Yes, the principal and interest payments are lower, but the amount of cash you have to have on hand is bigger. Let's go to the next slide. So for those who aren't able to transition quite yet into home ownership, there is a rental market. And what we have seen is a lot of strength in the single family rental market over the last couple of months. At CoreLogic, we've developed a single family rent index. And what I'm showing here is the rent growth year over year in our single family rent index, in our national index. Exclusively single family rent. There is zero multifamily rent in our index. We're exclusively looking at single family rent. And I had a lot of concerns when the pandemic hit and the national emergency was declared that as a result of the pandemic recession, we would see rents falling on single family properties. And indeed, you can see that the growth rate of single family rent fell from about 3% down to about 1% on a year-over-year basis. And I thought we might see something similar to what we saw during the Great Recession, where single-family rents declined for a period of time. Well, things have turned around quite sharply over the last few months, and single-family rent growth has picked up. It's a little bit different when, if one looked at multifamily rent. Multifamily rent still, many property managers are offering concessions. Multifamily rents are weak. In fact, the national projection from the consensus survey from the Urban Land Institute has a projection of multifamily rents down about 2% nationwide for 2020. Well, it's a different story for single family rent. Single family rent growth is up. Some of the challenge in the marketplace for consumers is the fact that affordability still is quite challenging. Home prices are up, rents are up, and they're up a lot faster than inflation. So shelter costs have risen a lot more. The dark blue bar on the left here is our CoreLogic single family rent index for the San Diego market. So the prior one was for the US, but we do it by metro too. So you can see in the San Diego market over the last 12 months, October 2019, October 2020, single family rent growth has been 2.9%. The green bar right next to it is the consumer price index. Consumer prices are up 1.2%. Now, about 30% of the CPI, the consumer price index, is shelter, is rent. So if you look at CPI less shelter, which measures how much consumer prices for all other goods, all other items that consumers are buying, is inflating, that's the yellow bar. That's the 0.8%. So shelter costs, rents, are rising a lot more rapidly than inflation in other goods. That's true in the last year. It's true in the last 5 years, which are the bars to the right. Rents have been rising significantly faster than inflation. Home prices have been rising significantly faster than inflation as well. Let's turn to the next slide. Before we go on to risk, I want to just talk a little bit about multifamily. Multifamily has really taken a bit of a hit here during the pandemic. Fortunately, for most properties, rental receipts are holding up. Not for all of them, but for most of them, they are holding up, and that's very important. There has been a lot of concern and uncertainty early on when the pandemic started about what would happen with rental receipts. And as you can see, the number of multifamily sales in CoreLogic's data fell substantially in April. Number of settlements on multifamily properties. It was the month with the least number of settlements for multifamily property sales in San Diego since November 2008. Not a long time ago, but that was the outbreak of the Great Recession. Just as a reminder, little economic history lesson, September 2008, we had Fannie Mae and Freddie Mac placed in conservatorship. Lehman Brothers went bankrupt. It seemed like the capital markets were in meltdown. And that was around that time, November 2008, the last time we saw as small a number of multifamily property settlements as we did in April of 2020. And indeed, multifamily sales are down by 26% compared since April compared to the prior year. We've developed a multifamily property price index as well. And so we can actually track what's happened with multifamily prices. And multifamily prices generally been rising for an extended period of time, thanks in part to the generational low in vacancy rates, thanks in part to rents rising faster than inflation, thanks in part to cap rates on a general decline over the last 20 years. Those have all been propellants that help push property values higher. But very interesting, in the second quarter of this year, our price index shows a drop in prices. We recorded a 10% drop in multifamily prices compared to a year earlier, and that was the first quarter that we had seen a drop in our multifamily price index and prices since the Great Recession, way back in 2008, 2009. If we turn to the next slide, we can take a little closer look at some of the markets. We construct the multifamily property index for the US as a whole, but for 10 select markets. And what I've highlighted here is New York, LA, Chicago, the three biggies in terms of high-rise rental housing stock, then San Diego as a fourth, and then what the 10 metro composite has done. The charts on the bars on the left are for the last 4 quarters. As a comparison, the bars on the right refer to a 5-year period prior to the pandemic. So prior to the pandemic, prices and values were up at a pretty good clip at an annualized rate. San Diego has had a pretty strong demand, and prices were up more in San Diego over that prior 5 years period prior to the pandemic. Things have really changed. We've seen a clear marked slowdown in price growth with valuation declines in a number of metro areas in New York, in San Diego, highlighted in red. Let's go to the next slide. I want to switch now and just share some thoughts on credit risk in the mortgage markets. I kind of subscribe to a dual trigger model of delinquency and distress sale. The first trigger is a shock to income. So thinking through what causes a borrower to go from being current to being delinquent to perhaps being in a distressed sale. The initial trigger event typically is a shock to income, unexpected loss of job, illness, death of a major breadwinner. And thinking back about what happened this spring during the pandemic, we went from the US went from a 50-year low in the unemployment rate nationwide in February of 3.5% to an 80-year high in the unemployment rate in April of 14.7%. 20 million workers were laid off in the space of just a couple of months. Totally unprecedented, totally unexpected from what workers would have thought expected in February. So a significant income shock. And then, of course, on top of that, we had a pandemic. So illness and sadly death affected the breadwinners and the income flow in many families as well. So contributing directly to delinquency, whether or not it leads to foreclosure depends on not whether home prices have fallen, wiped out home equity. And on this slide, I'm sharing our latest update on our home equity report. We actually just released this report just this morning. This is brand new, hot off the press. And these are our calculations of negative percentage of homeowners who have negative equity. And also in the report, we have information on home equity wealth, which is not on this slide. But I show this because to show that there are significant numbers of borrowers in each state that have negative equity and could be at risk of a distressed sale, especially if they've been impacted by the pandemic recession, and if the recovery is sluggish and unemployment rates remain high. And I've called out just a couple of states here that have relatively high unemployment rates. So Nevada has an unemployment rate of 12%. It's been hit very hard by the pandemic recession. A lot of jobs in hospitality, entertainment, travel, food, retail. So that's been a market that's been hit very, very hard. And we are forecasting for the CoreLogic Home Price Index a decline in home prices in the next year. Already in Nevada, about 2.7% of homeowners have negative equity. And so there could be some risk and exposure in that market, as well as in select other markets. And we may very well see some rise in distressed sales as we get toward the end of 2021 after the forbearance periods have come to an end. Let's go to the next slide. One thing that really helps to limit the extent of foreclosure risk or distressed sale risk is the fact that most homeowners have a ton of home equity because of all the rapid home price growth that we have seen in the United States. And this just summarizes what we've seen in terms of home price growth over the last decade and what we're forecasting for the next 2 years. We expect home prices to continue to rise, but at a more moderate pace than what we've seen over the last decade. More moderate, in fact, than what we've seen just over the last 12 months. And on this slide, I wanted to compare the US index with San Diego. San Diego, actually, we remain pretty bullish on. San Diego for quite some time has had home price growth that's been a little bit more rapid than the US as a whole. I expect that actually to continue, and we'll see quickening in home price growth here in the San Diego market over the coming year, in part because the economic fundamentals of the market remain pretty strong, and because there's such limited inventory on the market for sale. And with that limited inventory and with the challenges of producing additional single family affordable stock in the San Diego market, that's going to work to push prices up further. So that limits some of the exposure and risk in the San Diego market. And we can turn to the very next slide, which just summarizes some history on what we've seen with the serious delinquency rate on home mortgages in the United States, as well as a forecast that we have. Serious delinquency, as a reminder, is the percent of loans that are 90 days delinquent or in foreclosure. And fortunately, pre-pandemic in February of this year, the serious delinquency rate was at 1.2%. It was at a generational low. Since then, it's jumped by 3 percentage points, but it started to top off. And our forecast, which is based on a dual trigger model, our forecast is based on unemployment rate and house price growth, house price change. So we put into the forecast a forecast of the unemployment rate and a forecast for home price performance for the nation as a whole. And you can see that to the right of the chart, the green part is our forecast. We expect serious delinquency rates to continue to gently decline. Nonetheless, even by the end of 2021, serious delinquency rates are about triple what they were pre-pandemic. And I do think that between loan modifications, the opportunity to rebuild their financial house that's afforded by the forbearance provisions of the CARES Act, that most of these homeowners will be able to avoid distressed sales. But that is the period toward the end of 2021 when I expect what we might see an increase in distressed sales. And then this slide also shows the serious delinquency rate in San Diego. Because of the strong home price growth and strong local economy, the serious delinquency rate in the San Diego market was actually lower than the US as a whole. It also jumped 3 percentage points between February and September of this year. I don't have a forecast for San Diego, but just given our projection that we just showed on San Diego home prices, I think San Diego will actually continue to have lower serious delinquency rates than the US as a whole, and we'll see it gradually come lower over the course of the next year. So San Diego will perform much better in terms of mortgage performance than the rest of the country. Well, let me stop there and turn the baton back to you, Norm.
Thanks, Frank. And I think we're going to skip over this one question in the interest of time. And let me jump to a couple of the other questions to try to get a little bit closer to schedule. We did get started a few minutes late, but real quickly, just a brief answer. Your old employer, Freddie Mac, will the GSEs go private? And will that drive up the mortgage rates? Are they still too big to fail?
Hey, that's a great question. I don't know when they will go back to private. They're still in conservatorship, and certainly Director of Calabria, who runs the FHFA, has a plan or would like to return them into private management and private ownership. I don't think that's going to happen anytime soon. If it does happen soon, given the current capital regulatory framework, I think it does mean that mortgage rates will have to be a bit higher. How much higher? A little hard to say. I would say at least 1/4 percentage point higher than they otherwise would have been.
Right. Thank you. Next question. Bob Schiller, Nobel-winning economist, said we're approaching a housing bubble. Of course, he predicted a stock bubble a couple years before it happened. So, what do you think? Is this way too premature?
I think it is premature. The market is very different than what it was back in 2008. We've had very sound underwriting in place, very high quality mortgages underwritten in recent years. Yes, house prices are up. Yes, they are at an all-time high. But then again, mortgage rates are at a record low. If we were to see mortgage rates suddenly spike up, and again, I'm not forecasting that, I'm expecting that we're going to continue to have low mortgage rates. But if we did see mortgage rates really jump up, then I do think we'd probably see some weakness in home prices. And while I have emphasized our national home price forecast over the next year or two, I do see some weakness in some markets. I pointed out Nevada. I expect to see some weakness in Nevada. So even though the outlook overall for most markets and for the U.S. as a whole is that home prices will continue to rise, there are some markets with elevated unemployment that have been disproportionately affected by the pandemic recession, where we are likely to see some price declines in the coming year.
In that same light, where there's markets that will be affected differently, we're going to have price tiers affected differently as well. Bill Wheaton used to say nobody owns a median house in America, and we have all these different price tiers. And we know these frontline workers, retail workers, restaurant, hotel, haircutters, et cetera, are really being nailed right now. So are we going to see a slew of the lower priced homes in distress over the next quarter or so? And will that be a boom to the single family rental market as well? Somebody's losses, somebody's gain.
Well, I tell you, it's so interesting. That is, the lower price tier is the one that's been had the shortest supply and the strongest demand. And the demand is coming from first-time home buyers. It's also coming from investors who are looking to buy those assets and have them available for that expected increase in single-family rental demand. So far, we've seen actually very strong price growth. I mentioned that over the last 12 months in our national home price index, prices are up 7.3%. If we look at the lower price tier, it's up even more. It's up 9% for those homes that are priced just below the median price. So we've had a lot of strong home price growth. If that builds equity, if that gives skin in the game for the homeowner, it makes it a lot less likely that it'll turn out to be a distressed sale, even if the families had very challenging financial setbacks. They could always turn and sell the home, extract their equity, and take those proceeds and maybe put them in to even a lower priced home or move into the rental market.
Thank you. And I think you answered this next question a little bit on your example about saving money and that helping the economy. So we're going to pass it on to Kimberly Byrum with an overview, starting with the impact from Zonda's point of view. And so, Kimberly?
Great, thank you. Can you
it's
hear
yours.
me? Everybody hear me okay?
We
Great.
do.
Well, just wanted to quickly share some stats with you on the impact of the pandemic on the institutional quality multifamily units throughout the country. And this chart illustrates the drop in demand that occurred from the first quarter to the third quarter, and that is rolled up by regions of the United States. And as you can see, the West has taken the biggest hit to this point. Now, that's not to say that occupancies have fallen. What this is the absorption of units, which is primarily new units, because in the West, our average occupancy is, north of 95, 96% in most markets. And if you go and compare the lowest point of occupancy in most of these markets, we are nowhere near those numbers. But the new demand for apartments, in essence, is what has slowed during this time period. If you consider, and we'll jump over to the next slide, which breaks down the West a little bit more, because this is where the most acute drop in demand has been. You see that San Francisco and LA lead the way. San Diego's more in line with the US. And then you see actually some places in the West outperforming, for instance, Portland and Denver. Phoenix has been performing very well. And then Las Vegas is interesting because took a big halt in growth and demand in the second quarter, but actually jumped back into positive numbers. I think that's important to note, that there isn't a lot of new pipeline in Las Vegas. The institutional players in multifamily exited the market for the most part prior to the Great Recession. And so the pipeline remains in check in Las Vegas, and it is continuing to be one of the more affordable places to live in the West. And I think that we're seeing some of that absorption of the new units occurring there. Now, that's not to say that the job growth and the tourism and the drop there isn't acute, but there's definitely, I think, some illustration of that pay recovery a little bit, and then the migration into the area. So I also added just a little slide down at the bottom that shows where people are moving from, and primarily, moving from San Francisco to places like Seattle and Austin and Chicago, other large different cities within the United States. And there's a lot of different data suggesting, you can see some trends, obviously, in certain metro areas, and we'll get into that a little bit more in a second. Next slide is, so one of the big questions early in the pandemic was, will apartment dwellers pay their rent? And so the National Multi-Housing Council, in partnership with several of the third-party data providers, began to track that information and report that on a monthly basis, which has been very helpful. And as you can see, early in the pandemic, the comparison of year over year, so 2019, the number of renters who paid their rent compared to 2020 was definitely down 3.2% on a basis point level. But again, pointing out that, and I think Frank mentioned this earlier, most people are paying their rent. That's 90+% of the people have paid their rent. And you can see as we went through the summer, the stimulus really helped that. We really got back to par with his history in June of this year. Of course, that burned off, and you started to see a little bit of volatility, with October having somewhat of a drop again. I think some election, a lot of stuff going on there. So we're waiting to see what November brings for sure. And we're watching this closely. But again, I think for the most part, what this says is that people did pay their rent for the most part. If you look at some of the REIT reports, they're also doing a great job of reporting this. UDR says, and they are a coastal REIT for the most part, that they only have 500 residents on a delinquency plan, which is less than 1%. Camden, who kind of represents the smile in the country, is at 1.9% delinquent, and MAA, which is more of a southeastern, shows 1.2. So if you flip to the next slide, this actually shows you, it's hard to read, but it's a map of the United States, and again, provided by NMHC. It shows you where the uncollected rent is the most acute. And no surprise, but New York and Massachusetts, and interestingly, a little bit of a surprise, and I'm sure Frank can comment on this, but is Louisiana pops up as a very high delinquency rate. Again, heavily reliant on oil and the hospitality industry. So that pops up there. And then of course, Nevada, again, where the tourism market has been hit. And then, you know, I illustrated the other double-digit areas in the country. So we can flip to the next slide. So, you know, we're talking a lot about the single family home market being, you know, at a peak, and a lot of demand from millennials and the Gen X group. Of course, a lot of the Gen Xers don't live in multifamily anymore. But this was a survey that we had done, and just overall, so just statistically, pretty much my whole career spanning 30 years, you will see that about 20% of apartment dwellers move out, buy a home. And this was a survey that we performed a year ago with luxury apartment dwellers in Dallas. And as you can see here, that survey also kind of stayed along that 20% line. If you read Camden's second quarter report, they're reporting move outs for home purchase at 13.7%. Their peak was actually at 23% in 2005, 2006. So we're obviously watching this. But I think one of the interesting things is just the sentiment of buying a home. And while number one was, I haven't bought a home yet because I prefer the low maintenance environment, I wanted to point out that many of these answers are financial in nature. And so while the math works and the mortgage rates, you know, and all of the great slides that Frank shared about that, you still have many renters who have just this apprehensiveness towards home ownership because of the financial aspects of it. Some other interesting things, I think, are the tenure of a renter. On average, the respondents of this survey in Dallas had lived in an apartment for 4.5 years and planned to live another 3.5 years in an apartment. So just overall thinking about living in an apartment for 8 years. And they may live during that time period in at least 3 different apartment communities. So a lot of mobility there. So I want to flip to the next slide. Again, this is actually provided, one of the fun data points to look at, certainly always, but during a time when we've seen a lot of mobility that was, you know, quickly occurred, is to see where the U-Hauls are being returned to or rented at. And the blue is where people are moving in. Obviously, the red is where people are moving out. And so no surprise, the Southeast and Texas are big markets where we're seeing that. Of course, Phoenix as well is benefiting. Salt Lake City, and then Boise, which has always been kind of an under the radar market screen that people are interested in. Not an institutional market yet for multi, but definitely receiving some in-migration from other market areas. And then of course, no surprise that people are moving out of the coastal communities that are more expensive. I'm going to flip to the next slide. These are some of the cities in particular that have gained movement over the pandemic period. And I think what's important to point out here is that these are mostly the suburbs. And that is something that from the multi aspect, there is kind of this tale of 2 different performance metrics, and that is the urban core multifamily versus the suburban. And there has been a preference in most markets to move towards the suburbs. And again, so we're seeing definitely some different trends in terms of performance there. If you want to the next slide. This map actually makes me laugh when Norm put it together, because it kind of illustrates the Californication of the United States. And actually, I wanted to share the Dallas Morning News headline of the day, which was Elon Musk's relocation follows 687 other Californians who've moved to Texas in the last decade. And so that's not going to stop. That's going to keep going. And you know, this map, I think one of the most interesting things as a researcher that we want to figure out is where the people are going to move. But this has really created a great mobility effort that we did not see during the Great Recession, where people actually stayed put. And so we've got some really interesting opportunities here to maybe find some new markets and to open up housing for a lot of other people. Finally, one of the things I was, again, trying to predict where people may go. I took just thinking about the Bay Area tech workers and where they might go if they were going to leave town. And looking for, areas and not assuming that I've got a cost of living adjustment, I'm just going to save some money. Where might I move? And obviously in the West, some of your opportunities are Denver, Phoenix, Portland, and Honolulu. You can even move to Honolulu cheaper than living in the Bay Area. The Northeast, you don't have as many options. Philadelphia is one market. In the Midwest, Chicago is probably your only major metropolitan area, and you're not going to save quite as much as you might in Indianapolis, Minneapolis, or Milwaukee, but it's very, very cold there this time of year. And then finally, pretty much anywhere in the South, you can, make a lot more. You can give yourself a raise if you move to Nashville, Austin, Dallas, Houston, and Atlanta. And, they're all populous, but affordable markets. And I think that we're definitely seeing a lot of the green immigration dots in those market areas.
Thank you. It's interesting that if you can work remotely, you can pick your location and save money, and we're seeing that.
Yes.
Thank you, Kimberly. I'm going to turn it over to Peter now. And Peter, you're going to give us a couple overview from the perspective of the new housing development market.
Yes, good morning, everybody. So from a new housing market point of view, obviously 2020 has been a roller coaster. We had a really strong start to the year in January and February. Then we had a period of COVID-induced shutdowns, and I'm sure we all thought that the year was going to go very differently. But then we had a rebound back in new housing to very strong activity levels. And so I think for people that are involved in the new housing business, 2020 on balance is going to really be a surprise to the upside. Speaking for our own company, we're building about 20 projects in 12 states. We expected to do about 4,400 home sales this year. That was kind of our projection going into 2020. And we just passed 6,000. So we're at about 140% of what we expected from a home sales point of view. I guarantee that that is not what we expected in the middle of March when we were forced to shut down all of our projects literally overnight. And why was that? I think we've already kind of touched on a lot of the main points. Market conditions for housing were in great shape heading into the crisis in March. We had tight existing and new market supplies. Home builders were already raising prices, but we still had good affordability. Over the last couple of years, builders had really diversified their product in many markets, including San Diego, because prices were going up and they, offered a wider breadth of housing for the most part. We had low interest rates before COVID, and they just got lower. So most of the builders, reported a really strong start in January and February to the year. And then the other thing is that, mortgage lending, was much more constrained and much more tightly controlled. So I think we heard earlier that the level of distress, that we might have expected did not really wind up developing. And if you saw yesterday's Union Tribune, you saw the story that says that San Diego is actually on track to build more housing in 2020. So a really strong year. Both single family and multifamily permit issuance is ahead of last year through the first 3 quarters of the year. So again, we're ending a really strong year, and projections going forward for new housing starts, permits, again, I think pessimistically, we might have been ratcheting those back in the middle of the year, but those have really been generally coming back. And I think most people in the new home side of the world expect next year to be better to somewhat better than this year, and then tied to expectations for economic development, economic kind of resuscitation as we recover from the downturn. I think you can go to the next slide. So this is a survey that I think LendingTree did of what people were looking for in new homes and apartments. And we've heard many of these themes in the market, in the media in the last couple of months. People who are shopping and buying during this year were looking for things like bigger yards, bigger kitchens, cooking more at home, not eating out. Home office space became a huge priority, both for parents and children as children schooled at home. Pools at home, because public pools or community pools were closed. And the gym moved to the home. So really, it all kind of translated into the home became the center of the life for even more functionality than we had at the beginning of the year. Dining, schooling, and everything. Newland did a survey of our shoppers and buyers this year. This has been a really, this has been a very motivated group of buyers in particular this year, especially if you bought during the March-April timeframe when you had to deal with kind of closed sales offices and online experiences. And yet during that time, we had people respond. We found that most of our buyers were very comfortable with the virtual buying environment, just like they would be with buying a car or any of the other things that you do online. Although they do, we found, they do want more of the personal touch when they, get serious and they're finishing up. We also looked into what was motivating people during this year. And one thing that was interesting, just kind of an overall, we asked people why they bought during this year. Did you buy because of COVID or not? About 80% of people who purchased homes in our communities across the country this year said that they were planning to buy a home anyway before COVID. About 20% said that COVID moved their plans up. So, 1 in 5 buyers this year. And, I think I mentioned earlier that we're about 40% over our projections. So we certainly pulled forward some buyers that might not have acted as quickly this year. Probably because of the need for different functionality and definitely the low interest rates. The number 1 and 2 reasons people said that they pulled their purchase up this year were because they wanted a better sense of community. They might have been living in an environment where they didn't want to be anymore, maybe an older home or an apartment. And then the second thing was interest rates. That really motivated people to act sooner. And in our surveys, which also focused on community things, we found that the better sense of community, access to outdoor recreational spaces like walking trails and pathways was a big motivator. We saw flex spaces and formal office spaces also kind of reflecting what LendingTree found. And then just outdoor spaces at home, bigger yard areas seemed to be very important to people who acted during this year. So because they anticipated being at home. I think we can go on to the next one.
I wanted to let Kimberly jump in on this one as well, because she's done a lot of survey research work. Kimberly, did you have a follow-up comment on this?
Well, we definitely provided some ideas in the appendix, so I definitely would refer people to that. But from a pandemic, and I don't want to say pandemic proof, but if we want to, we're talking a lot with our clients about this type of stuff right now, and the home office space is definitely something. I think multifamily put a piece of granite off in a corner a couple of years ago and called it a home office, and it failed miserably. So it's something a little more deliberate in terms of design of office cubby space. Typically about 45 square feet is what we're suggesting. Also, personal workout space is something that we're talking a lot about. Where a place to put your Peloton, especially if you're a downsizer, so that you can work out in your home, those types of things. So obviously the work from home, offering space within the clubhouse that is secured, and a private work opportunity. So different things like that we're talking a lot about. Obviously, we want to make sure that those are premium options and for our renters. And so again, some ideas that we put back in the appendix.
Thank you. I'm going to skip through the point that's been made about inventory being down. And let me just quickly, Peter, did you want to comment on this slide before we go to some questions?
I think it just shows that there's a broad-based price increase in all areas, from La Jolla to Chula Vista, the more affordable areas of San Diego to the least affordable.
The interesting thing from my point of view is that when you look at the price tiers, the lower price tiers have not appreciated as much as some of the upper price tiers. And I think we see that throughout the country. Yeah, North County, San Diego's done particularly well. We're gonna hit this question. It's too important to go through, but the question is for Peter. Newland's not on this list of builders in this area. We have our suspicions why Newland's not on the list, but can you tell us why not?
Yeah, so this is a list of people who are building homes. So we don't build homes, so we develop the communities and the lots, so we wouldn't be on the list. But what stands out to me here is that these builders who are building homes in San Diego are not building them in a Newland community. If we have been based here for 5 decades. We built numerous master plan communities and tens of thousands of housing units. If you did this list 10 years ago, projects like Forest Ranch or San Miguel Ranch would have been on the list. So we would have been represented. But at the moment, I think that the environment for new master plan community development is very challenging. A number of projects, including ours, have faced challenge for environmental or regulatory or referendum issues. So it's really challenging to bring forward a new master plan community that would give these builders a place to build new homes in the county. It is easier. I think you also wanted to ask me about whether it's easier building in Texas versus California. I've learned that it is indeed. Our project manager who led our recent efforts to get approvals for a master plan in North County recently relocated to Austin, and by recent, I mean August, and has already got 2 deals in the works there to deliver over 10,000 housing units over the next couple of years. And so in the works, I mean, obviously, there'll be an entitlement to some degree in those projects. I'm not saying it's 100% different. We do have entitlement issues all around the country. A lot of other states are more like California every year, I hear. But it is easier to get deals. There is land availability, and we expect to deliver homes in either of those projects within the next 2 to 3 years. In contrast, the project that we just recently kind of had to put on hold in North San Diego County, we pursued entitlements on for over 7 years, and then we're subject to a referendum. So it really is a long staying ground.
Could you comment briefly on this one?
Yeah, this is a map showing where new housing projects are located in the county. And what's interesting is, most of them, no surprise, are either in the far north San Diego County, really focused around the I-78 corridor, or in South County in the Otay Mesa Chula Vista area or along the border. And so, most jobs, if you look at the red, that's really where employment concentrations are today in San Diego. So a lot of employment in central San Diego, no surprise, UTC, Kearny Mesa, all those areas. Not much housing being built in the very employment-rich center parts of the county. It's really kind of at the extreme north and south areas, where either land is more affordable or where either land is more available or prices are more affordable. Something I'm always a little surprised by is that we don't really see a lot of what I consider to be affordable infill single family or attached development in the closer in areas. Projects tend to be small and or high end, like in, say, downtown San Diego.
Thank you, Peter, Kimberly, and Frank. I'm going to turn it over to Staff Karras for questions that have come into the chat box now.
Thank you, Norm. We'll get to some of the questions here. First, I see a comment from Hal Richardson that just says, "Feel your pain, Peter." So you have others out there that I'm sure are experiencing the California, I don't know what I would call it, I guess, the California squeeze on trying to get housing built in our communities. I did change my background. As you can see, I did that for Andy Hunt, who's a friend of ours up in Milwaukee at Marquette. Just to let you know, Andy I've got my back door open and the temperature is pleasant here. In regard to your comment about the Midwest, you got a dress for it. So tech workers, I know are welcome up there, but you know, we're going to try and keep them down here. So let's get to some of the questions that we have here. I'm going to start from the top. Alexander Allione, what was the U.S. home what was the U.S. home equity, negative equity share is a question. What was the U.S. home negative equity share during the great financial crisis? I don't know if that's who's best to answer that question. Go ahead, Frank.
No, that's a great question, and we keep track of that over time. It was about 1/4 of all homeowners with a mortgage were in a negative equity position at the trough of the house price cycle. This is back in 2009, 2010. So we went from 1/4, 25%, down to 3%, thanks in large part to home equity growth. The other thing we look at in our report is the average amount of home equity that a typical homeowner with a mortgage has in the US. That has more than doubled over that same period of time over the last 10 years. The average homeowner today has $194,000 in home equity. Again, more than double what the average was for homeowners with a mortgage a decade ago.
Thank you. And by the way, you know, Kimberly and Peter, if you have more to add to any of these questions, just don't wait for me, just jump in there. Next question from Brian Brady. This is for you, Frank. As a home snap user, thrilled at CoreLogic's recent purchase because of its data-driven research. Is the goal with this purchase to take on Zillow and empower the professional user?
So good question. I think it's to improve the quality of the products and the access to clients. You know, we are a B2B company, so the focus really with all of our you know, technology development and data analytics is to provide the resources to our clients, other businesses, to help well, basically help the industry, help consumers find, buy, and protect the homes that they acquire. Again, we don't deal directly with the consumer. We are strictly B2B, and that's with our acquisitions. We have that with a view in mind of developing technology, developing data analytics, to help our clients, our business clients, meet the needs of their clients, of people, of consumers, of families.
Thank you. I'm going to actually throw my own question in here in the middle of this for all three of you, because it relates to either single family or multifamily. So we talk about the supply-demand imbalance here in San Diego and in the state of California. You know, where in the country do you see a reasonable balance in that supply and demand?
Well, I'll give it a shot. Maybe a better balance. I'm not sure it's reasonable anywhere because we have an acute shortage of new production and inventory for sale of existing homes. I see a better balance in Texas. So some of the comments earlier, you know, about the relative ease of building in Austin or other markets in Texas, I think is really very reflective. There's better supply. That's meeting some of that increased demand. And so we're not seeing quite the same price growth pressures. Prices are still up. Don't get me wrong. Prices are up in the big metros in Texas, but not quite as much. So it's a better balance of supply and demand, even though, again, even if you look at Austin, Dallas, Houston, inventory for sale is down relative to a year ago. So again, there is this shortage of supply, but it's not as acute as it is, say, in Southern California.
I think I would echo that. I mean, we were very, you know, we were very anxiously looking for regional differences or, you know, whether markets like Houston would really suffer because of the oil industry or anything like that. But what we really found is that we performed very well throughout in places like Texas, the Carolinas, Florida, Phoenix. After a brief closure in the Northwest, we have a project near Seattle, and Washington was closed down longer than California was for new home construction. That market has really rebounded. So it's really been a broad-based thing. Although I do think that, projects did better where they had, a broad mix of housing. They weren't focused on either the upper end or the high end or active adult. We did find active adult buyers were a little bit slow to come back to the market in, kind of the March, April, May timeframe, but after June, that activity really started to improve wherever we had a project with active adult.
Yes, I would just add to that the Texas markets run at a low 90s, 92, 93% overall, with 3% or less rent growth, in just on average over the years, versus a California that's in the high 90s, 95 to 97%, or the Northeast that is also 95 to 97%. But what I think is important when you're building into the growth markets where it's easy to turn the pipeline off and on, is differentiation, and because you are competing at a very high level with a lot of other developers, and so that's the biggest thing, is the differentiation.
Staff, if I can jump in. On your question about supply and demand, you really have to get granular. A year ago, we did see Miami Beach condos had about a 3-year inventory. They had built too many. And that afterwards, they're going to have a softening market. Now, in markets like California, we generally don't have that problem of oversupply. It's such an inelastic supply here, and so difficult to get things approved. But wouldn't you say, Kimberly, Peter, Frank, that right now, we have a supply-demand imbalance between the high-rise urban and the suburban, and we have this big migration going on as a result of it?
Well, that's definitely in my wheelhouse. I've probably worked on 140 high-rise buildings over the last 5 or 6 years. The latest generation of high-rise has been mostly small units, and what we're seeing right now in the market is the people that have left the urban core have been the studios and the 1-bedroom dwellers, and the 2-bedrooms seem to have stayed and been more resilient. The renters by choice choosing to live in the city and doubling down there. And so it will be interesting to see, and I'm watching that very, very diligently when those folks come back, when the cities reopen. But for now, we're definitely seeing the challenging floor plans in the high rise, in the studios and ones.
Right, and we may see that reflected in what people, generally across the board, people are asking for more space, more yard, more rooms, more function. So there seems to be kind of like, which, may not be the trend in recent years. Home prices, I think, or home sizes were kind of trending down as people move towards affordability or attainability, but that, more space is really what seems to be motivating a lot of people who are active this year.
So I want to thank everybody for joining us. Frank, Peter, and Kimberly, 30 seconds on your outlook next year.
Norm, sorry to jump in. If everyone's okay, we still have some more questions. Is everyone okay to stay on a little longer and answer some questions? Okay.
We'll go ahead and handle maybe 5 more minutes or so.
I think we're good for another 10. At least that's what we had planned for. If it's okay with that.
That sounds fine.
Okay. So a question: how many or what percent of the U.S. mortgages are currently in forbearance?
CoreLogic actually collects data from our servicer consortium, and they've reported that 8% of their loans are in forbearance as of the end of September. Now, there's additional updates that are provided by week by the Mortgage Bankers Association in their forbearance survey, and they're showing since the end of September, the percent of loans in forbearance have come down a little bit further. Now, there is a deadline for filing for forbearance. If you have an FHA insured mortgage, You have until December 31st, the end of this month, to request forbearance if you haven't done so already. So there is a deadline coming up for some of the loan products to file for forbearance.
Just to be clear, Frank, I mean, you're talking about 3 or 4 million loans that could be foreclosed on if forbearance is not extended much into 2021. Is that right?
It's possible. I think that, personally, I think that'll be on the high side because there's so much home equity wealth right now. When I think of what drives a foreclosure or a distressed sale, come back to that dual trigger model. We need something that causes prices to go down or loan balances to go up. So some of the loans that are, some of the borrowers who are in forbearance programs, they're going to be offered a loan modification. If the loan modification is one where you take the foreborn payments and tack it onto the loan balance, well, that erodes some of that home equity wealth. I'll give you a real simple example, just taking some average statistics. If a homeowner has been in 6 months of forbearance, has not made a payment for 6 months, and if the servicer takes those 6 months of foreborn payments, tax it onto the loan balance, on average, that wipes out about 3% of the home equity that the family has. In other words, the loan balance is 3 percentage points higher. So to the extent that's part of the loan if that's offered as a loan modification, and if that happens in a market where the borrower already had a very high LTV, like they had an FHA loan or a VA loan, say, and if home prices go down, gee, that could wipe out equity, and that could then be the trigger for a distressed sale. Your typical homeowner's got a boatload of home equity. As I mentioned earlier, on average across the US, the average amount of home equity is $194,000 per homeowner. That's not for everybody, but that's an average.
Thank you. This next question, I'm happy to say, comes from a student of mine last semester, Mariano. His question: if demand for new multifamily has decreased so dramatically in places like the West, why have rental rates continued to increase? Regardless of the supply shortage, shouldn't this put downward pressure on rental rates?
Well, the rental rates have declined. You know, there's a couple ways you need to look at that. There's the survey rent data, which is same store rent, apartment available to apartment available, minus the concession that's being offered. And then there's also renewal activities. And you'll see that those are down. Renewal is down close to zero for right now, whereas, for instance, in San Diego, the rents are down 2.6% as of the third quarter data.
Frank, a quick question for you. Someone was just asking on data on median household income versus home price over time, which I'm sure you folks collect. One thing that maybe a lot of folks don't know is, how do they access your data? Is it a subscription nature? Maybe you can just give us a quick pitch for CoreLogic and how people can get access to your data.
Oh, sure. Yeah. Some of the data products and the raw databases, those are subscription. You need a license for it. But there's some information that we make available through data releases, press releases. We have a kind of like a Tuesday cadence on it. So the first Tuesday of every month, we have the CoreLogic Home Price Index. There's a press release with some summary information. The second Tuesday of every month is our loan performance indicators. That's where we provide information on delinquency, foreclosure rates, top 10 large markets, et cetera. The third Tuesday of every month is when we release our single family rent index. Again, it's a national index, but we also provide information on about 20 metro areas in the US in that press release. The last Tuesday of every month, the Case-Shiller Home Price Index, which we provide information on jointly through a dissemination with S&P. And then we have a special release on home equity that we do once a quarter. I mentioned that earlier. This morning, we released our quarterly home equity report. And that's what serves as a basis for the information on negative equity, as well as the average amount of home equity wealth that households have. So that's part of the cadence. That's available for free. That's up on our website, as well as our insights blogs. We have that up on our website as well, where we provide some thought leadership to the industry at large. Those are the freebies. And many of our other data products and databases do require licensing, a subscription.
Thank you, Frank. We've got two more questions. The next one I'm going to ask for all of you to respond to. The question that's being asked, a lot right now. So in some of the new units for rent and for sale, a little extra space in there for the home office. What's anticipated in terms of, from your perspective, in terms of the work from home trend that has gathered a lot of momentum? Where do you see that going once the pandemic is behind us?
Kimberly, you want to start?
I'll jump in. Well, from a multifamily perspective, the average age nationally of, for instance, Camden reports, I believe, 31 to 32 years old. And, as an employer of many people in that age group, I'm often pondering and thinking about how I enjoy working from home, except for the leaf blower, by the way, that's outside right now. But I really enjoy that. But how am I going to grow my people? And at the end of the day, I've got to get back in the office to shepherd my 30-somethings along so that they can become better consultants and professionals in their goals. So, overall, I think we're going to get back to the office because we've got to grow our people, and that group of people that's being lost right now that are hired out of school, which I've got a guy that we hired that's working remotely now. So I think that ultimately in the multifamily space, we'll see some do the work from home at some point. And, we're counseling our clients to, pick some 700 square foot units and design those deliberately for a work from home opportunity. And that could be a premium. If you really need a true home office space, you're probably going to take a 2-bedroom. So, I think that, we don't want to outfit every unit, but we want to have some, in that 700 square foot is where I'm targeting. 800 square foot 1-bedrooms are always harder to lease. That is kind of that move up person that might be in a 2. And so, the industry is, as a whole, stays away from those for the most part. So I would say that would be in the 700 square foot is where I'd focus.
And Peter, what do you think from your builders? Peter,
I was just going to jump in and say that Gensler has done some kind of interesting research on that notion of who wants to stay at home forever. And I think the idea of what Kimberly kind of mentioned is the idea of social capital. The way that they kind of put it in their study is that, especially younger workers, if you go work at home for a period of time, you're relying on the relationships and the expertise that you kind of develop, but you're not necessarily growing it. So that's really important for people at the younger stages of their career in particular. I agree with Kimberly. I like working at home too, and I have the flexibility to do it. But I also don't like the noise. And my daughter happens to be finishing high school at home as well. So I actually find that the office is quieter and I can get more done than I do at home. So, I think that people will adjust in their own particular work lives, but it's a great idea. I don't know that it's gonna go one way or the other, but people will want, I think, better spaces at home for when they do work there. That's really what I think it's about.
Norm, Frank,
I agree.
Go ahead.
I agree as well, and I saw a recent survey report from McKinsey & Company that reflects that too. I think that's one of the lasting changes that we'll see as a result of the pandemic. What I mean is that there'll be a certain portion of work time that will be done from home rather than from the office. Well, we may see the large majority of employees come back from home into the office. It may not be 5 days a week, in the office. It might be 2 days, 3 days a week in the office, 2 days, 3 days a week working from home. So we may have that blend, that mixture, so that we have some staff back in the office partly for some of that nurturing, that development, that on-the-job training, and yet each of them spending a portion of the time working from home, maintaining that demand for additional space at home for use as an office or maybe as schooling. I think another lasting effect of the pandemic is the greater use of technology, not just for communication, but when we think about home shopping, whether it's for to buy or to rent an apartment, we've seen agents be very creative in using video technology and 3D, three-dimensional videography in marketing homes. That pre-pandemic was really only for the the real high-end homes. I think we're going to see that become much more broadly available, even for moderately priced homes going forward. So the pandemic has, I think, will have some lasting effects on how people use space at home versus the office, as well as the use of technology in real estate, in the property markets.
I think that's a great place to wrap it up. There's going to be a lot of changes. I simply wanted to mention that we have a lot of materials in the appendix here, some great design ideas from Kimberly and her Zonda group, and some additional slides from Peter and others. So we really appreciate everybody joining us today. And I do want to once again thank our sponsors. And if you're interested in the slide deck, Diane will be sending those out to you. So Frank, thank you so much. Next time we hope we're in person. Peter, thank you. Kimberly, thank you. Attendees, thank you all for joining us today.
I want to add my thanks to each of you, Kimberly, Frank, Peter. Really, really appreciate your time. Two items that I'll mention before we close out. To the left-hand side of your screen, there are two buttons that we encourage you to press. One is the students support student success. If you want to donate, our mission is fully focused on our students, and through our sponsors and through your donation efforts, we're able to support our student group. Last, if you can join us for networking, there's a networking button there. Please click on it and we'll jump into networking. And with that, we will close out the program officially. Thank you again.